Welcome back to the Scholar Wealth Podcast. In today's episode, we're answering 3 listener questions that all came from the same business owner, a regular listener of the show who reached out with a few thoughtful year-end planning questions. As always, we value the privacy of our listeners, so we won't be sharing any identifying details. Each question touches on a different aspect of running and managing a business, from tax considerations to equipment purchases to employee benefits. We'll take them on one by one and walk through how to think about these situations from a planning perspective. So let's go ahead and get started with question number 1. I've heard about tax benefits related to racehorses and farm horses. Do similar tax rules apply to other working animals like reindeer used in a business? So when we look at the use of working animals, or for instance, like draft horses, race horses get a little different. We'll talk about that too. That's a common audit area from the IRS. But we want to start looking at whether or not this is a legitimate business or this is a hobby. That's generally where you start having working animals and farm animals, the gray area there. So if you start naming your reindeer or anything, then it's possible that that becomes more of a gray area of whether or not these are pets and this is just a hobby of yours, or if this is a legitimate business that you need to be using. When we start thinking about things like draft horses, and I imagine depending on how you're using the reindeer, they would fall under the same kind of categories. Now they're not explicitly stated by the IRS, but draft horses would be under a 5-year depreciation. And you have to start looking at whether or not there's a profit motive there, ordinary and necessary business use. And the big thing is going to be record keeping. So documentation of you using these animals for actual work and not for resale. So if you were in the business of selling reindeer, then you'd have a problem there if there'd be considered kind of inventory and you wouldn't be able to have to do the same issues. So what we need to think about is really how they're being used and how often they're being used, if this is an ordinary and necessary business use, or if you could use something that would maybe be a little bit more efficient. We don't know, but you'd have a little bit more credibility if this was an ordinary use in the business. If this was something like, on the extreme example, let's say you're only using the reindeer like 1 day a year, then it might be more difficult for you to say that this is a necessary and ordinary use. But I think the big thing to take away, and this comes in the case with a lot of different businesses, is just because you enjoy the business that you're in, or if it's a novelty, doesn't change the tax treatment. So as long as it meets the requirements of a profit motive and this being an ordinary necessary business use, then I can't imagine that there would be any issue. But this is a great situation to bring up with your tax and maybe your legal team, but definitely your tax team, to determine where those reindeer fall in the category of draft horses to race horses, which tend to be a prime issue when it comes to IRS audits, because race horses tend to fall in that hobby realm as opposed to business realm. So now we could jump into our next question from our listener. I recently invested in a very specialized piece of equipment for my business, a sleigh used exclusively for deliveries. How should I think about depreciation for something like that? So when we look at sleighs, unfortunately, they're not going to be a vehicle. So because it's not a vehicle in the traditional sense, we're going to be looking at this as business equipment. So the depreciation amount that you get is going to be how much of that use is going to be for business use and whether or not there's going to be any personal use as well. Fortunately, there's some depreciation benefits, Section 179, bonus depreciation, everything else that may allow you to depreciate that entire asset, the entire sleigh, all within the first year. But you have to make sure it meets the certain eligibility requirements. And that tax law around depreciation regularly changes. So it might be a good year for you to knock that out before December 31st, as long as the end of the year isn't too busy for you to take care of that. But we also get into another aspect that I always recommend all business owners take into account when it comes to spending on vehicles or sleighs or anything along those lines, is that what is the actual asset that you need for the business? And are you using the business as justification for a new sleigh? In other words, is the old sleigh doing the job that it needs to do, or is there an actual use for it? Because while there's a tax benefit of depreciation of you buying the new sleigh, that doesn't mean that we should let tax benefits determine that decision. So in other words, as you're trying to go out and determine the new sleigh for you to buy, maybe you avoid the Ferrari of sleighs out there just because you think it'd be more enjoyable, get you around a little bit faster if time's a concern, and focus on something that's a little bit more practical for your needs. And then our final question. I have hundreds of long-tenured employees, some of whom may work for centuries. Many have unusually high sugar consumption due to the nature of the job. How should an employer think about retirement plans, health benefits, and long-term sustainability for a workforce like this? This is a mess. This is definitely a problem we have to take into account because when you start looking at retirement plans, especially, and we'll talk about the health benefits and the sugar consumption afterwards, but one of the things that I would because we really do need to balance generosity with long-term sustainability. In other words, when you start picking up retirement plans, for instance, with the high tenure that your employees have and their longevity risk, a pension would be really problematic because generally pension benefits are based on a certain percentage of compensation multiplied by the number of years that they've been working for you. So if you're multiplying by hundreds, that becomes a problem, especially if you're able to pay out for a long time. So if we wanted to shift that financial risk from the company balance sheet over to the individual, then you would do what most people have done, which you would go to a defined contribution plan. I think that would make a lot more sense in your situation, but definitely something to consider when you start looking at the health benefits. Health benefit costs absolutely rise whenever you have longer tenure and lifestyle factors. This is where you start having different types of programs for preventative care and cost management from healthcare benefits. So maybe implementing a program that had a little bit less cocoa, more cardio, right, would be a good balancing act there to help on the health benefit side. So the one thing I would keep in mind as you go about this is really a periodic review because of the long tenure of the employees and the longevity risk associated with this. Your whole benefits package really needs to be reviewed regularly and reviewing not only what's being offered, but what those costs are and anything that you can do to support not only the retention of your employees, assuming they have a lot of other skills that could be used in many different industries, but also creating long-term benefits for the employees themselves and sustainable for the business to avoid any long-term strain on the organization. So that wraps up our questions for today. And if these questions felt just a little bit seasonal, we'll just say that the episode is coming at a perfect time of the year. So thanks for listening. We hope you and your family have a great Christmas, and we'll see you next week.
The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your individual financial situation, objectives, and risk tolerance. Thanks for listening.